Ever placed a trade and ended up with a different price than you expected? Well, that is called slippage and it really affects your trading results. Don't worry, in today's video, we'll break down it. What is slippage, why it happens, how can you manage it, especially using platform like QuantMan. By the end of this video, you will be having a knowledge about slippage and you will make a smarter trading decision. Let's get into the video. First, we'll see what is slippage. Slippage happens when the price you want to buy or sell, but it actually executed in the different price. This can occur because of delays in processing your order or sudden price changes in the market. To put it simple, slippage is gap between the price you expect and price you get when your trade is executed. For example, let's say you want to buy a stock at rupees 100 and you'll click the buy option when the price is 100. But by the time your order is executed, the price have been gone up to rupees 102. That rupees 2 difference is called the slippage. Slippage can be either positive when the price moves in your favor or negative when the price moves against you. Slippage can impact your returns, especially in market volatility and low liquidity. Next, we'll see the types of slippage. There are two types of slippage: positive slippage, negative slippage. First, we'll see the positive slippage. This will happen when the price moves in your favor. For example, you will place a buy order at 150 and it will be executed at 148. Now you got a better price than you expected. This is called positive slippage. Next, we'll see the negative slippage. This will happen when the price moves against you. For example, if you place a buy order at 150 and it will be executed at 152. This means you have paid a different price than you expected. Now we'll see why does slippage happen. Slippage usually happen because of few key reasons. First reason will be market conditions. Slippage is more common when the market is moving very quickly, such as after big news and events. These events cause price changes that happen too fast. Second reason will be a low liquidity. Slippage also happens when there is a less buyers and less sellers where the price you want to buy. When there is a low liquidity, your order will be executed at a different price than you expected. The third reason will be order types. There are two types of orders: market order, limit order. First, we'll see the market order. This can be executed immediately at an available price and you will be experienced a slippage because you are accepting what the market offers. Next, we'll see the limit order. It allows you to set a price you want, but there is no guarantee your order will be executed if the price doesn't match your target. Next, we'll see how to avoid this slippage. First one, we can use the limit orders. One of the best way to reduce the slippage is by using a limit order. With a limit order, you can set a price that you want to buy or sell at which price. The order will be executed if the market reaches to that price. Next, we can monitor the market condition. Stay and follow the market news and events strictly. Trading during times of high volatility can increase the risk of slippage. So, it's better to avoid trading during this time if possible. Now we'll see how to manage a slippage using QuantMan. There are three methods to manage a slippage in QuantMan. First, we'll see how to add a slippage while backtesting. For that, first we have to create a strategy. Go to create strategy page and start creating a strategy. After creating a strategy, you can see a submit button option. Click on that. Now you will see a backtesting results. In this page, you can see a slippage pop-up box. Here you can add a slippage in percentage as well and rupees as well. After adding a slippage, you want to give a go option. If you give a go option, it will show the results after deducting a slippage. This will help you to understand how slippage impact in your strategy before risking your real money. Next is slippage controls using a limit order. Second one is slippage controls using a limit order. For that, we have to create a strategy first. Go to create strategy page and click on an option called live. After clicking a live option, you can see a two order type that is called paper testing and auto trading. Click on auto trading. Now you want to create a strategy. After creating a strategy, you can see a order execution details here. In order execution details, you can see the entry order. After clicking on entry order, you can see a two option called market and limit. Click on limit order. This order allows you to specify the exact price you want to buy or sell. Next one is slippage in scalping. If you are a scalper, the slippage can have a big impact. QuantMan can help to speed up the trade execution and reduce the slippage in fast moving market. So that's it. In this video, we have covered what is slippage, why it happens, how it affects your trades. We have also explored how to manage a slippage using a platform like QuantMan. Remember, slippage is a part of trading and we got to know how to control it. For more such videos, don't forget to like, share, subscribe to our channel. Happy trading!